Entering trades with indicators provides non-biased trading signals that are perfect for systematic traders. Indicators are based on mathematical calculations that will produce exact values, and traders can then use these values to make logical trading decisions. A right mixture of indicators can also produce more accurate trading signals that help traders to improve their trading performance. We have an entire section reserved for indicators, as they are the core components for our tradings of trading indicators out there. For traders, it is important to understand the nature of your indicators. For example, is its use for trend following, or is it an oscillator used for trading in a ranging market? Understanding the context of when to use which indicator allows you to make intelligent decisions on applying which indicator in your trading strategy. The market is either trending or ranging. Newer traders should decide which market condition they want to tackle first and complete their trading arsenal later after they have a working strategy in one market. Apart from indicators that solely focus on price, there are also indicators that focus on other important factors such as volume and volatility. They can act as a good confirmation indicator to improve the win rate of a strategy. Adding them to your trading strategy could improve your performance significantly when used correctly. Open your chart on TradingView. On the top toolbar, select the button where it said Indicators and Strategies. You can search for the name of your indicator or click on Built-in to scroll down the list to explore a list of indicators. Click on How to trade their indicator correctly to fully utilize their power. There is no one way to trade indicators. Every trader can develop their own unique trading logic on how to trade based on the values calculated by the indicators. There are plenty of resources on the internet where you can get inspiration on how to trade an indicator. Trading books and YouTube are good resources for finding trade ideas. But remember, there are many false information too, so watch out. Look for those that provide clear trading rules so you can use the testing methods I later covered in this course to verify their edge. Avoid those that are ambiguous and difficult to validate its performance. It is rare to use only one indicator in a trading strategy to get the job done, usually requiring a combination of at least two indicators to create a robust trading strategy. Because using only one indicator can only give you a trading signal, but without another indicator to confirm the signal, the win rate of the strategy could be compromised, as there will be also many false signals. A popular combination is using an indicator that tracks price with another indicator that tracks volume or volatility. When combining indicators, it is advised to first start with an assumption on why the selected indicators could work together. For example, the reason why we combine price indicator with volume indicator is that we assumed when price movement is confirmed by volume spikes, it means there is conviction in the price level, and therefore the momentum is more likely to last for a prolonged period for traders to take advantage. However, this is just a trading theory. It is our responsibility to verify whether our strategy can profit from our assumption. When you are creating your strategy, think of a trading concept first, and find the relevant indicators to validate your assumption. If you find this video useful, click like, subscribe and hit the notification bell, so you can get the latest updates. Thanks for watching, take care, and see you next time.